Right, let's get straight into this explainer on CoreWeave. Today, we're looking at a crazy balancing act. We're going to weigh CoreWeave's truly explosive AI infrastructure growth against some very real and honestly pretty looming macroeconomic risks. If you've been wanting to understand where the billions in AI are actually flowing right now and what could potentially disrupt that entire pipeline, you are absolutely in the right place. We're going to break down their financials, dig into their competitive mode, and look hard at the broader debt market that is fueling this whole industry. Let's get to it. Just look at this number, almost $100 billion. That represents CoreWeave's contracted revenue backlog as of Q1 2026. Almost $100 billion in forward-booked revenue. Honestly, in the world of cloud infrastructure, having that kind of crystal clear visibility into your future cash flow is practically unheard of. It just goes to show the staggering appetite coming from AI developers and enterprise tech giants right now. But seeing a backlog that massive really forces us to pause and ask a critical question about the sustainability of this whole AI build-out. Basically, is CoreWeave an unstoppable AI juggernaut carving out this unbreakable monopoly in high-performance computing, or are they sitting smack in the middle of an impending debt-fueled bubble? To answer that, we have to look under the hood at exactly where this cash is coming from. And, well, here's where we find a pretty glaring risk. 62% of CoreWeave's revenue comes from just one single customer, Microsoft. Now, don't get me wrong, having a trillion-dollar hyperscaler as your anchor client is a dream for early growth. But it creates immense concentration risk. If Microsoft ever decides to just bring more of this infrastructure totally in-house, using their own custom silicon, CoreWeave's biggest revenue stream could face some serious pressure. Now to see how that revenue breaks down over time, we can look at their remaining performance obligations, or RPO. It shows that while they have $2.1 billion booked for the next 12 months, the vast bulk of their contracted revenue, about $5.4 billion of this specific RPO slice, is actually locked in for beyond the next 2 years. They're securing these rigid take-or-pay contracts that guarantee revenue way into the future. That gives them a massive buffer against any short-term market hiccups. But, and this is a huge but, building the physical data centers to actually handle all that future demand is not cheap at all. Management's Q1 guidance is projecting a staggering $31 to $35 billion in capital expenditures just for fiscal year 2026. Think about that. They're spending tens of billions upfront on data centers, networking, and GPUs long before the bulk of their revenue even hits the bank account. It's an incredibly capital-intensive game they're playing. The good news here, and the crucial point to remember, is that this unprecedented spending is actually matching realized demand today. CoreWeave isn't just burning cash, they are earning it. Q1 revenue completely surged, up 112% year-over-year, crossing the $2 billion mark. They are officially operating at a multi-billion-dollar annualized run rate, proving they can actually deliver these powered data centers to their clients. And it gets better, because CoreWeave is holding on to these clients at an elite level. They're boasting a 155% net revenue retention rate. That means not only are their customers sticking around, but they are dramatically expanding their usage, spending 55% more than they did just last year. Just to put that 155% into perspective for you, they are blowing past the median public AI infrastructure market, which sits at about 126%, outperforming it by a massive 29 percentage points. When your customers are scaling up their own AI models, their need for computing power grows exponentially, and CoreWeave is perfectly positioned, catching all of that upside. So, how exactly are they building this massive moat? Well, let's compare CoreWeave against one of its main pre-IPO challengers, Lambda Labs. CoreWeave is laser-focused on the enterprise hyperscaler, locking them into rigid 2 to 5 year take-or-pay contracts for massive 100-plus GPU clusters. Lambda Labs, on the flip side, is much more of a developer darling. They offer flexible, on-demand compute for individual researchers. So basically, CoreWeave has traded day-to-day flexibility for deep, guaranteed enterprise cash. But CoreWeave's real superpower, their ultimate structural advantage, is all about NVIDIA. With over $2 billion in strategic backing from NVIDIA, CoreWeave gets priority allocation for the absolute latest, most coveted chips on the market, like the GB200. Throw in their native 400 gigabit per second InfiniBand networking and an investment-grade customer base like Meta, OpenAI, and Anthropic, you're looking at a platform that competitors literally cannot replicate overnight. And because of that incredible stability and client quality, they just pulled off something wild in the finance world. They secured an $8.5 billion delayed draw term loan priced below 6%. It's called DDTL 4.0, and it marks the first ever investment grade rating for high performance computing infrastructure debt. This is a massive structural shift in how they fund their operations, drastically lowering their cost of capital compared to basically any early stage startup out there. Okay, let's flip the coin here because we have to look at the bear case. And it starts with their Q1 GAAP net loss, which widened to negative $740 million. Now, you might be wondering, wait a second, if they are making $2.1 billion in revenue, how on earth are they losing $750 million in a single quarter? It all comes down to the mechanics of how aggressively they're expanding. It's driven by the lag in actually activating these data centers. Think of it like a giant puzzle. Step 1. CoreWeave gets a powered shell building and immediately has to start paying lease and power costs. Step 2. They spend a month or two fitting it out with all the tech. During that time, depreciation hits their books hard, but they are earning zero revenue from that building. It's only in step 3, months down the line, that margins finally normalize. So they are literally growing so fast that their upfront build-out costs are temporarily crushing their profitability. But there is a light at the end of the tunnel here. The analysts over at Bank of America expect this margin pressure to ease up as more of that capacity finally comes online and starts generating real revenue later in the year. They're tracking an operating margin progression that starts at a tiny 1% in Q1, but climbs to a much healthier 14.6% exit margin by Q4 of 2026. All right, let's zoom out for a second, because beyond CoreWeave's own balance sheet, there's a serious macroeconomic storm brewing in the background. Back in January 2026, the U.S. Senate sent a letter to the Financial Stability Oversight Council, and it highlights a systemic risk that directly impacts the exact AI infrastructure market CoreWeave relies on. The Senate letter isn't pulling any punches here. They are warning that this whole projected $3 trillion AI boom is heavily reliant on what they call shadowy and opaque debt markets. The primary concern isn't just that tech companies are spending billions, it's how they are borrowing that money to fund these massive data centers in the first place. Basically, there's an estimated $1.6 trillion funding gap over the next few years, and to fill it, tech companies are doing some incredible financial gymnastics. We're talking $800 billion projected from private credit funds, plus asset-backed and commercial mortgage-backed securitizations and special purpose vehicles. Regulators are really sweating this because these alternative pipelines obscure the true leverage and the real risk sitting right underneath the AI boom. A perfect example of this complexity is something called credit tenant lease financing. Honestly, just imagine taking out a massive multi-billion-dollar commercial mortgage, but keeping it entirely off your company's main books by using a special purpose vehicle, all before the data center is even built. It's a clever way for companies to look a whole lot less leveraged on paper than they actually are in reality. And that brings us to the ultimate nightmare scenario for regulators. What if the AI's software demand just doesn't show up fast enough? Building the infrastructure is one thing, but if the software companies renting these GPUs can't generate enough actual revenue from end users, they won't be able to pay back these massive debt loads, and that could trigger some massive systemic financial shockwaves. This big picture macro fear about a potential debt bubble, especially when you mix it with CoreWeave's heavy reliance on Microsoft, explains a lot about the current market sentiment. It's exactly why CoreWeave's market cap has actually dropped nearly 36% over the last year, settling at around $41.14 billion. Even with their massive revenue growth and flawless execution, investors are clearly pricing in that broader macro risk. Now, to be completely fair to CoreWeave, they are executing flawlessly right now. I mean, they are essentially operating as this highly efficient, debt-fueled data center acquisition machine, heavily armed with an undeniable NVIDIA-backed moat. They are doing exactly what they said they'd do, scaling up infrastructure at a pace that the world has rarely seen before. But as we wrap up this explainer, we are left with this massive, multi-billion-dollar question. If the broader AI software market cools down and that debt bubble actually starts to pop, will CoreWeave's $99.4 billion ironclad contract backlog be enough of a shield to protect them? Or will the sheer crushing weight of their upfront capital expenditures drag them down with the rest of the market? It is definitely the question that's going to define the next era of tech. Thanks for joining me on this deep dive, and as always, keep learning.